Hi, I'm Todd Rosenbluth, and welcome to another episode of ETF360. Today, I'm pleased to be joined by Brian Ellis of Morgan Stanley Investment Management to discuss CVSB. Brian, thanks for joining me.
Thank you, Todd. Good to be here.
It's a pleasure to have you here. So congratulations on the launch of the first Morgan Stanley ETFs. Let's talk about the short-term fixed income product. Why was that one of the first products you guys launched?
Sure. Thanks, Todd. Well, first of all, we are very excited with the launch of the Morgan Stanley ETF platform. This really gives us the ability to deliver our active fixed income strategies in the ETF format. So really a lot of excitement across the firm there. One of the reasons that we're leading with a short duration fixed income product, in CVSB, is really the opportunity that we see today in the current market environment. Yields are very compelling at the very front end of the yield curve. On the one hand, by taking a small amount of more duration risk, you can earn much higher yields than you can in cash or in more traditional money market mutual funds. And on the other hand, given the shape of the yield curve, you can earn similar yields without having to take on a lot more of that longer term duration risk much further out the curve. So, it's really an attractive spot on the yield curve for investors right now.
So there are a range of other short-term fixed income products in the marketplace, but what's unique about this fund is it includes an ESG focus. Why do you think that's important?
Well, just like any active fixed income strategy, investment performance and managing risk is our primary goal. As part of that, there is a lot of ESG information that is financially material, and integrating that research from our dedicated ESG research analysts into our investment process really provides us with a much better understanding of the issuers that we invest in.
So you touched on this being active management. Why is active management within the fixed income space, specifically the short term, also important to you?
Well, it's been shown that active management does work very well in fixed income. We think this is especially true for short duration strategies. It's a very large opportunity set, and when you look at the market, there's really a lack of what we would consider to be appropriately diversified benchmarks. And so in an active multi-sector approach, we think that investors are much better able to really strike that balance between more yield, but also not being too concentrated, in any particular part of that market. And so the enhanced yield in combination with the appropriate level of credit and sector diversification, we think is actually very important, and you can really achieve that in an active strategy.
So let's just bring this home with the overall outlook on short-term fixed income. Why is this now a good time to be investing in the space?
So we think the policy rates are likely to stay elevated, for some time. Even if the Fed is nearing the end, of its hiking cycle. This has been a very fast hiking cycle. This should keep yields elevated at the very front of the curve for some time. What we like, what is becoming more attractive in this environment is the actual headwinds that we saw, in the last 12 months with those rapidly rising rates. That will become less of a headwind, from this point forward, even if the Fed may have one or two more hikes left. So investors should feel more comfortable moving out of the yield curve, even if it's a slight amount from cash or in a money market fund. We also think the volatility and uncertainty in the macro environment will persist for some time. We like the more higher quality investment grade rated sectors. We think that they stand to outperform in the year ahead.
Well, thanks, Brian. Thanks for sharing your expertise, and thank you everybody for tuning in to E360. We'll see you next time.